So welcome everyone again to another Collateral onboarding call. Today is Wednesday, November 25th of 2020 at 6 UTC. And today we're here joined by Dennis, Victor, and Jure from, sorry, I forgot the name of your project, guys. This is
From Blocksquare.
Blocksquare, yeah, I keep saying blockchain and then it's like, no. So I'm really sorry about that. From Blocksquare. And yeah, they're going to explain their project and hopefully we can have an open conversation and ask questions, interrupt a lot, and they can tell us more about the project. So Dennis, sorry again for the name, and the floor is yours.
Yeah. Well, thanks. Hi everyone. I'm Dennis from Blocksquare, and we started a discussion on the Maker forums. I think a bit more than a week ago, and I think it started to get some traction. So it was really cool, and thanks for the invitation to have this presentation today. Maybe I can share the screen if that's fine. Is there a screen? Here. Okay. So you see the screen? Sure. So at Blocksquare, how we kind of position the company is an infrastructure provider. And basically, it's nichely oriented to real estate and the tokenization of real estate. So the problem on the real estate market is that there's a lot of illiquidity there, and that's because real estate has certain specific challenges, I would say. So besides being it's an asset that is a big lump sum, so it's capital intensive. It's hard to evaluate, so you need a lot of information, and usually that limits it to being extremely regional. It takes a lot of time to do this due diligence, and thus becomes hard to access. And the problem here is that there's markets that are just not liquid enough. And that's because if you look at the wide picture, there's this data on terms of commercial real estate that most of the capital each year that's being poured into real estate deals is done in only 60 cities. So when you go to talk to real estate brokers in San Francisco or in London, you see that they don't have really this pain point of illiquidity, because the real estate there is very attractive. So all the big investors just going into these markets. But what's outside of those markets is basically neglected from the main sources of capital. And so we see that tokenization will kind of change this. And it's already doing this, but on a very, very kind of small, in a very small manner. But things are moving ahead. And I think that we will see a world where properties are tokenized and where those tokens have a lot of liquidity, where those tokens are actually traded on an hourly basis instead of a property being bought and sold in a 10-year time frame. And that's just because the benefits of this tokenization are so immense. So, and I don't want to bore you here, because I guess you guys being in the real world assets working group, you fully know these benefits. And you also know that the amount, the potential is really big. So there's a lot of real estate assets around the world. And if we would just tokenize just 0.1%, that's already a lot. And Maker is obviously seeking routes to get this as collateral, to onboard this. But I think that the challenge here of this collateral onboarding is not onboarding assets directly, but how do you onboard protocols that will enable platforms or portals, let's say, to build up upon this and then kind of crowdsource or outsource this collateral onboarding, so to say. Now, what we learned in this couple of years is that even though there's this big potential, there's nothing really happening in terms of real estate tokenization. There's a couple of projects or test cases, let's say, that have been done, a couple of announcements, but then there's nothing that happens. And we went to kind of research in the real estate industry why that's the case. And to sum it up, this is basically what happens. The real estate industry is very tech unsavvy. When they go and ask some companies for the issuance process, it just becomes too expensive. So there's many other financing routes, I would say, that they already leverage, and they get them to a certain outcome. They know how much it will cost them to get money from a bank. They know how much it will cost them to get equity partners into a deal. And they know that they can get there. They know what will happen. While when they go to think about tokenization, the more they research, the more uncertain it becomes. There's this cumbersome legal framework that revolves around the tokenization of debt, the tokenization of equity. And so when you ask real estate professionals, they say, we're not going to do this because you cannot give a certainty. And, if this will require us to hire expensive lawyers to do, we're just going to do what we always did. And so the kind of solution where Blocksquare is focusing is to provide and to commoditize, in a way, the tokenization process, basically to bring the cost of doing it down by offering two things. One is a tokenization protocol, and the second one is a platform, a portal that's white labeled. Why white labeled? I'll touch on that point later on. And why this tokenization protocol is a way to standardize the issuance process and to kind of make it compliant by limiting the transferability. So for instance, if Maker is a permissionless open system where anyone can join, the protocol that we built requires KYB, KYC to be accessed, and also from the perspective of a token holder, they need to be identified. And that's because we, by touching real world assets, real estate, the requirements for AML needs to be exercised, right? So to make everything unified, the protocol we built is essentially converting properties into a top of 100,000 tokens. So each property gets a single smart contract that can issue 100,000 tokens. Now, we don't see that properties will be tokenized in full, but that will just be an addition, a digitized additional slice in the traditional capital stack. So in a way, we see tokenization living together with equity and debt investment instruments. Now, if we're not tokenizing equity and debt, what are we actually doing? So the protocol we built revolves around the notion of revenue-based asset tokenization. Now, in commercial real estate terms, how much a property can generate is also reflects its valuation. And essentially here, what we're doing is the issuer of the token basically says, look, I'm giving you a portion, a percentage of all the revenues after taxes that I will generate with this property for each token that you hold. And where 100,000 tokens is basically represents all the revenues that are generated through this real estate property. So if I'm issuing 10,000 tokens, I'm giving out 10% of those. And why here we're being kind of focusing on this top line revenues instead of bottom line, let's say, revenues or bottom line even profits, which usually equity gives you a stake in the profits, is because the real estate, the real estate business has a lot of costs, and these costs can be manipulated. So if you're going to distribute profits, why don't do it on something that investors recognized easily? And you as a property owner, as the main stakeholder in the property, you know the business you're doing, so you know how much of those revenues you can share with token holders, instead of offering a stake in let's say in bottom line profits. Now this protocol is built in, it's built out of two portions, I would say. So one thing is an ERC20 contract that has also information on the property and is managed, the transactability of those tokens is managed through a smart contract system. And the second part is a legal document, which is uploaded to IPFS. And I'll just show you how this is done in practice. So we use the system to issue a smart contract. Now this smart contract has obviously a public address. And what we do is we then generate a corporate resolution, which is basically a decision by the company that owns the real estate asset. And we input information on the property here. Now this corporate resolution also holds the information on the token contract and its address. Now the second step is then to take the shareholders or the decision makers within the company that owns the real estate property to sign off on this corporate resolution. Basically, the legal document has 3 pages, and I shared the link to a sample, to actually this sample on the forum. So you can go there and you can see the legal provisions that are included in this corporate resolution. Why we chose a legal document like a corporate resolution is because it's valid only, and the only thing that's required is it being accepted by the stakeholders of the company that owns the real estate property. So in terms when you are creating a loan, usually there's 2 signatories, or when you're selling equity, there's also multiple signatories, 2 parties. Here, just one party is making a statement of the company's position. And now then the third part is actually uploading this legal document to IPFS and then putting the IPFS hash, registering it with the smart contract. And now this works together. So now we have a legal document that transfers revenues in proportion to token holders. And on the other hand, we have a smart contract that manages the tokens, and basically each address that holds tokens in a way is entitled to whatever the legal document says. Now the second portion of what we've built is a portal. So we saw that the real estate companies and people that we talk to, they're not tax heavy. So we wanted to make them an offering where they can basically launch an investment portal without any coding involved. and we needed to add certain functionalities to it so that they can verify and KYC investors. We based this around DAI as a stable coin through which the investments can be made. We integrated various wallets, and everything runs on Ethereum. Now, the platform, as I mentioned, has a couple of functionalities, but what we built alongside with it is also an API. So if there's a company that's more tech savvy, they can build their own interface using the API. And as I mentioned, there's also an exchange that's built on 0x. The tokens, the protocol is also compatible with Uniswap. So a pool can be also created for each tokenized property. There's obviously a lot of information that's not on-chain, but there's also a big portion that's stored on-chain. So you have valuations of properties that are stored within the smart contract. There's actually two types of valuation that are stored. One is a more traditional one that can be backed by a report by an appraisal, or the second one is a token valuation, which is basically the valuation of the tokens that are actually traded on secondary markets. There's information on the property, for instance, the geolocation of the property. There's information on how much of the revenues will be distributed. There's also information such as the projected, not the information of obviously the token holders and all of this. And then there's this part which we store on our servers and we calculate there, which is kind of projected yields based on the current tokens available on the secondary market. And because revenues are distributed through a smart contract, there's a history that can be recorded. There's also a capital stack that can be recorded at each issuance and updated at the issuance time. So for each prop token, you know how much debt there is and how much equity there is. Because you cannot basically issue 30,000 tokens if your equity and debt are more than are 80%, let's say. So that kind of limits how many tokens you can actually issue based on the equity portion and the debt portion. How we kind of see this working together with Maker is because Maker in essence could be Blocksquare could benefit from Maker being a financing provider both for issuers and prop token holders. So in the forum discussion, we had this conversation where it was really well put by Sebastian, I think, where he kind of said there's this B2C and B2B notion for Maker. And right now, Maker is mainly doing this B2C collateralization. They don't actually need to, there's no, only the top tokens are accepted as collateral. So here, in an analogy to this would be that only the top tokens issued through Blocksquare would be maybe accepted for collateral. So that would be an extended function for whoever invested in those tokens, in those property tokens. Now, a second approach would be a more B2B kind of route, where basically Maker would finance directly the issuers. And there is a lot of due diligence that needs to be done, and obviously much more risk. On the other side, what Blocksquare can provide to Maker is a real estate protocol that creates collateral with a lot of on-chain data. There's metadata of properties, but there's a lot of data in terms of revenue distributions and so forth. And so here, I think that there's solutions that what we've built can help Maker solve certain issues that were mentioned on the forums. So for instance, if you have a lot of on-chain data, you can create a risk scoring based on that. You can compare issuers and assets between each other because you have like a standardized kind of issuance process. And which then results in essence in less work for a risk team than it would be to onboard each real world asset in terms of real estate, let's say, separately. Now, what I also mentioned there's this multi-layered due diligence process where in essence, what we do is we do due diligence on the companies that want to launch an investment portal. Then those companies do due diligence on the assets that they want to list on their portals. And at the same, because they need to attract an investment community. And this in essence creates a multi-layered process where kind of fraud is tried to be mitigated by kind of crowdsourcing the process. And in the end, for Maker, it could be a good way to diversify risk, because you don't have, although you have a protocol through which you can accept these collaterals because it standardizes the process, you can still operate how much of certain tokens can be collateralized depending on the portal itself, the quality scoring of portals, quality scoring of issuers, and of the assets that those issuers kind of bring on chain. And so Blocksquare, we've been around for some time. We've been one of the first companies to tokenize one property in 2018. We tokenized another property in 2019. And we worked on a lot of case studies. Mainly, we got very well acquainted with real estate companies saying it's too early. But along the way, we were also able to get some recognition for the work we've done. And this is our team, and I hope we can get a discussion around this going today. Thanks.
Nice, thank you, Dennis. Are there any questions to kickstart the conversation?
I have a question. I don't know if you mentioned this, but what are the various transfer restrictions applied to the token?
The transfer restrictions applied to the token are managed essentially by the portal that lists the tokens. So we kind of saw there's this problem that doing just one platform is just not going to work, because a company in let's say in Germany will be much more equipped to do due diligence on the issuers in Germany, and the investors will be probably more revolving around the German-speaking let's say area, which means it brings down to the choice of the portal operator to kind of set up transactional rules for the tokens that are issued and listed on that portal. So there's this limitations that there's this KYC we do. We obviously identify each user, and each user is then kind of has certain properties, and the portal operator kind of chooses to onboard, to whitelist basically users based on the information they receive from in their admin panel.
Got it. Yeah. So I guess what I'm more getting at is in some of the other real world asset applications we've had, the liquidation, so to speak, are handled off chain. So let's using 6S Capital as an example, a trustee is going to liquidate those assets if they ever need to. How would you liquidate these assets on chain given the transfer restrictions and demonstrate that there will actually be liquidity in the event that the asset is liquidated?
Yeah, I think here there's two parts to it, right? One is liquidating the tokens. The second part is liquidating the underlying asset. So
and just to note, for Maker's perspective, we only care about the prior.
Yeah, so the liquidation of tokens is how we see it. It could be the implementation itself could be done so that we create a smart contract that doesn't require KYC, where basically maybe we would not essentially do a direct collateralization with the prop tokens themselves, because they are kind of they need to be they fall under KYC requirements. But we could create like a pool where those property tokens are pulled in, and the collateralization happens to another kind of an LP token of sorts. So that would be one way of doing it, and offering then this when the vault is liquidated, that the keepers kind of can sell those tokens back.
I didn't totally follow that. Could you run me through the flows?
Yeah, so if we would, for instance, if a property token directly would be accepted as collateral, then the keepers would need to be KYC'd, right?
Yeah, that's correct. They'd probably also have to be broker dealers if the token is a security.
Yeah, exactly. So the one way of doing it is to work on that. So to have a community of keepers that goes through KYC and is compliant, right? There's another way of doing it where you can add another layer of, let's say, complexity to it, where there's a broker dealer that actually holds the property tokens and issues another token that is not, it has no restrictions, let's say, in terms of transferability.
But what is that other token, and why would somebody buy it?
It would be a pool token, a token that has a stake in a pool of properties, for instance.
And how is that not a security?
It still is a security. I'm not saying it's not. It's just the same security as the token that you kind of mentioned.
Yeah, but if the reason we can't liquidate it is because it's a security and needs KYC and broker dealers, how does adding another security solve the problem?
I'm just saying that there's always a way of working around stuff. I'm not saying this is the route how this should be done. I'm just saying that there could be this possibility. But I think that if you want to just keep online, I think working on a let's say on keepers that are compliant, that should be kind of the way of forward, I would say.
Yeah, I would definitely agree with that. I think that building out that regulated keeper ecosystem is probably going to be important for these kind of assets.
Yeah, I mean, in the end, I think it also needs to be kind of trusted. And if you have this participation of kind of registered keepers or keepers that are identified, and I don't really see why not, because the requirements are not that high. If this is companies that deal with this, it's a simple KYB kind of process, right?
Yep, totally. Thank you.
Sure. I have a quick question related to the revenue. When you were mentioning that the company signs a corporate resolution, in effect, you're basically tokenizing a revenue participation agreement, which I think is quite novel. The question I have, though, is how is that like actually implemented in the context of, well, whoever is paying that revenue, where's the crossover point where you're going from fiat into a token? How is that managed?
Thanks. I think it's a good question, and how we kind of see is that the portals either they provide the service themselves to do this transaction. So if you imagine yourself being a portal operator, your basic work is doing due diligence on the issuers, so basically establishing a business relationship with those companies that own real estate and become issuers on the portal, and you create agreements with them on how you conduct business. And one of the services of the portal could be also to provide this exchange where they basically invoice them for the amount they make this exchange into DAI and make the distribution on chain. So that's one way of doing it. The other way of doing it is to have the issuers themselves do that directly, which I think it's more far-fetched because these are essentially the tools that they're not used to. The real estate asset owners don't know crypto, more or less. So I think it's a service that these portals will kind of offer. Or another way of doing it is integrating a service provider from on and off ramp between fiat and DAI.
One question.
I'm trying to. Oh, go ahead, please.
Sorry. So to Greg's point, of course, we would prefer to have on-chain liquidations in Maker, but other implementations are actually using off-chain liquidations as well, because it's just we just can't find a way to make them on-chain because of all these constraints that you all mentioned. The thing is, with the property token that you issue, I'm not really sure if even off-chain liquidations are truly possible, because as I understand this token, it kind of represents some sort of unsecured debt or maybe some kind of mezzanine, because you have this upside on higher revenues, which means you have an upside on equity in some sense. But the token itself, it doesn't, as much as I understood, it doesn't really give you some kind of economic rights to have, repossession of asset and then liquidation, actually selling. Can you actually sell the asset and then get your loan repaid? Because if you're only counting on royalties into indefinite future, Maker would actually be stuck with the assets, and that's not preferred.
My question was kind of similar, like maybe I got it all wrong, and please correct me if I'm wrong, but it feels that this is more like equity and the promise to earn something which is potentially variable compared to debt. So if the project for any given reason starts making profits, it seems that this would just not yield any returns. Is that right, or?
Well, so in terms of real estate, the actual value of the property is usually kind of commercial real estate is kind of attached to the revenue that it can generate. So in terms of liquidations, how we see is that there's, in terms of off-chain liquidation, let's say there's a property where there's, I don't know, 30% equity owned, and then there's a bank loan of 50%, and then there's a tokenization of 20% involved there. And if the bank would go and foreclose on the asset because, you know, the equity holder just doesn't do their part, or the project is mismanaged, or whatever the reasons, then it depends on the debt agreement what the bank needs to do. In some cases, the bank would just say, hey, we're going to liquidate this asset to repay the debt to us, and what else we don't care, because we don't need to care. In some jurisdictions, they would not be able to do that, but they would need to sell the asset for the highest possible price, maybe through an auction. And then the hierarchy of repayment would go in the following way, where the token holders would get repaid before the equity holders, but after the debt. Now, this is in terms of default. When there's no default, but actually there's just the liquidation or the sale of the asset to a third party, the resolution actually states that the token holders are entitled to a proportion of the revenues generated from that sale. So, for instance, if in this case 20,000 tokens were issued, then 20% of the resale price should go to the issuer, is obligated to make this payment. The recourse of token holders not getting paid is obviously legal dispute. And even if there would be another way of securing this, let's say there's maybe a mortgage, a second mortgage on the title that the portal owner actually exercised, because that's how they do business with the issuers. Then the portal owner will kind of be, the portal operator will kind of act as this trusted party to recapitalize on the tokens that his investors or his community of investors has invested through. So they will be kind of this this off-chain litigator in a way, or off-chain representative for these token investors. Maybe I explained a bit on those questions.
Maybe then it's useful to put an example, but my question is not even, and Primoz will hate me a bit for this, it's not even about default and things going wrong, but even if things go right, when someone, being maker or someone else, gets these tokens, do you know what future returns to expect, or it's more like I'm buying Tesla and I hope it goes up compared to...
Yeah. Okay, I understand. Well, these tokens are attached to revenues. There's this public promise of the issuer to share revenues in a certain proportion to the token holders. So that's one thing. Now, the revenues are split into two fields. One is those recurring revenues, let's say, that come from lease contracts. And then there's revenues that come from a resale. Let's say that we tokenize land, and there's no recurring revenues at all, but there's a sale price at which tokens have been sold. And the corporate resolution provisions for the issuer to repay the token holders at least at the price of the highest price they ever sold tokens directly. So legally speaking, they are kind of bound to do that. Now, a fraudulent issuer could always say, I don't care, and not do it, obviously. And that's why I think that this track record or the history that is kind of proven on-chain can be leveraged by Maker. So if you engage in Maker to onboard collateral directly, you won't have all the due diligence is essentially off-chain, right? While if the onboarding is done in time based on an issuer's track record or a portal operator's track record, then that kind of becomes data that you can use to say, hey, I really trust this project, or I really trust this issuer. And in a way, it's similar to crypto collateral, where tokens of more, let's say, more solid projects are being onboarded, where I think tokens that don't have enough liquidity on markets, that there's a lot of parameters that maker would never accept. Maybe they would think of it, but consider it, but they would never accept it until certain criteria is met, right?
Yeah. Yeah, sorry everyone for taking all the questions. So my question is, because right now when we issue kind of like a loan in DAI, we put a fee which is equivalent to the interest rate. But I'm guessing that in this case, that would not be the case. Like, you would be sharing any potential revenues, but they would not be determined by what we call the stability fee.
I think it depends on, Sebastian, maybe you can step in here, because you made a great analogy on the forum where you kind of said this B2C and B2B notion. And so I think this is something that in terms of real world assets collateralization needs to be taken into account, right?
Yeah, sure. There is two possibilities. Either we use the token directly as collateral, and we get the royalties as fees, or we ask a third party to take ownership of the collateral and put it in the vault, but not getting, transferring the ownership to maker directly, and just taking a loan to refinance the token. So someone can buy a token for $10, use it in Maker to get a loan for $7, and we can charge 3%, 4%, 5% interest rate. So on the other side, the borrower will have the rent or the royalties from the property, which might be above or below the interest rate, depending if the property is rented or not. And so most of the time, the interest rate should be lower than the rent or the royalties, because it doesn't make sense if not. But in any case, we still have some kind of buffer between the value of the loan and the value of the royalty token. And that allows, even if there is no income on the royalty side, to increase our loan by accruing interest and making it work until it doesn't, and then we have to liquidate the token.
Sounds good. Does anyone have any questions or comments?
Yeah. So thanks, Dennis, for handling all the tough questions. I got a simple one. With regards to restrictive tokens, is it possible to do an ERC 1404? I would imagine yes, right? So assuming I'm a commercial property owner, I have a mixed use property, and I want to raise some money to fix the building, I guess I could go generate some register securities as tokens, use your platform to get these tokens, and then give them out to the people that want to invest, right? And then I could put some restrictions on it with something like an ERC 1404. Is that something that, I guess what I'm saying is, the simplest way to look at your platform is, this is good for someone who's willing to play the game by the rules, register it as a security, like Greg said, and then use the tokens that you use to raise money through the Maker Vault.
Yeah, I mean, definitely, if you're any token that's being issued, and if it offers some kind of revenue from it, revenue sharing on the best kind of management of others. It's basically a security, and that gets you into regulated waters, which means you need to restrict all the transferability and actually identify any token holder, etc. So yeah, in a way, it's that's how it works. Yeah, so I'm not directly familiar with the ERC you mentioned. Exactly where they make limitations. Is it on the transfer function, or is it some in another way?
I think it's used to in the transfer function to restrict you from selling it or using it as a.
So there is a whitelist, I guess.
Yeah.
So that's basically, yeah, and that's basically the same way of doing it, except we have this whitelisting registry or whitelisting contract, and there's some other functionalities on top of it, so that different portal owners can kind of manage different whitelisted lists in a way.
Got it. Cool. Thank you.
Thanks.
Any other final questions? I want to use the last 5 minutes to get an update from Seb and his cat. So yeah, if you have any questions, now is the time, guys. Okay, we'll take the silence as a no. So Seb, do you want to give us an update on the real world assets working group and how things are moving on that end?
Yeah, sure. So we are working. We will have some real progress this week and next week, as we will issue the risk assessment of 6S, so Matthew's project. New Silver, and most likely Consulflight as well next week. So these will be 3 assets done from a risk perspective. We still have some work to be done from the smart contract team, but I think for 6S it will be done MIP 21, if I remember correctly. It will be done maybe in December. And MIP 22, so for Consulflight will be done a bit after. So I wouldn't say that we will make our first loan for the real world assets this year, but it should be quick. I hope so, at least.
What will be the next steps afterwards, once that this risk assessment is released, and then there's the assessment from the smart contract teams? What will be the next step?
It's the implementation. Everything should be done on a smart contract perspective. But there is also a lot of work, mainly for Matthew. If Matthew want to comment, you're welcome. On setting the trust and all the legal stuff needed to start the lending.
Yeah,
okay, are we waiting until the? Oh, sorry, Matthew, go ahead.
No, I was going to say he's exactly right on that. We have to finalize the compliance requirements for both the trustee and from the broker-dealer, and form all the legal entities that are required, or at least cause them to be formed, and get all of the documents executed, put everything together, and then put everything in the forms so that people can review it, answer questions, and then be able to have an implementation vote.
Are we waiting for the assessment to do this, or is it something that's being done in parallel?
In parallel.
Okay. Any other thing that you guys would like to comment about the status of the real world assets?
After the risk assessment, so the risk assessment doesn't lead to any vote or anything, just some advice or guidelines so that the maker governance can do a final assessment at the end. But after the risk assessment, the risk team will have to work a lot on building the processes and the infrastructure to monitor the real world assets. It's quite different, as most of the stuff is off-chain. We cannot just go to Etherscan to check stuff. It's not that easy.
Sounds good. Okay, any other one has anything to say about real world assets or collateral onboarding in general? All right, so thank you again, Dennis, Victor, and Jure from Blocksquare for coming to the call. It was very nice having you, and let's keep going the conversations and the work in the forum.
Thanks.
And I'll see you guys next week.
Thank you.